Good morning and welcome to this session in which I'm going to talk about analyzing a financial statement and using that information to decide on different things about a company. Two things that you might want to decide is one, whether or not you want to be an owner of that company by buying its stock, or whether or not you want to be an employee of that company by taking a job offer, say. Well, there are two predominantly basic financial statements. One is called the balance sheet, and the other is called the income statement or statement of profit and loss. And the basic equation of the balance sheet is that the assets of the company, that's all of the things that that belong to the company, so to speak, is equal to the liabilities. Liabilities are debts, basically, of the company. So plus the net worth. So it says that everything the company owns is either obtained by borrowing money, liabilities, or by the owners putting in the money. So that's the basic equation of the balance sheet. That's what has to balance. The assets equal liabilities plus net worth. There are many things about both the balance sheet and the profit and loss statement that you want to read about in all of this, but what I want to emphasize is that the balance sheet itself is basically a static picture. It tells you what the company's financial condition looks like right now, whereas the income statement or statement of profit and loss covers a period of time. Say, well, they have to do one every quarter because corporations must submit quarterly income tax returns. So they have to have an income statement or profit and loss statement which tells them how much income taxes they have to pay, basically, and a lot of other things it tells them as well. But the assets on a balance sheet, and I'm going to give you an example of one here. It's a very simple example. But you see here, I've listed at the top assets, and then as a subcategory, we have current assets. Well, current assets are assets that can be converted to cash or that you expect to be converted to cash within 1 year. Okay, so that's how you define a current asset, converted to cash within 1 year. Well, certainly, and they're all listed from the top down in order of liquidity. What does liquidity mean? It means the ability to convert an asset to cash. Well, the easiest thing to convert to cash is cash. It is cash, right? So that's the top of your list. That's like if you think of a store, that's the money in the cash register right now, okay? Marketable securities, well, you may own securities, or basically stocks and bonds. You may own stocks or bonds in other companies. And if that's the case, you could sell them and convert them to cash basically within 3 days. So that is very liquid, okay? It's a liquid asset. It can be converted to cash very fast. The next thing is accounts receivable. When you sell a product, when a company sells a product, they usually send the product out to the customer. They also send the customer an invoice. It says, you owe us so much money for this product now. And these invoices are usually payable within 30 days. So this is accounts receivable. If you have good customers who pay their bills, they're going to be converted to cash within a period of 30 days. Then you have notes receivable. Well, some kind of a loan or something like that. And companies sometimes do sell their product to their customers on credit. And they basically take out a loan from their supplier. And but those notes or those loans become notes is sometimes another word for a loan. They become due pretty quickly. It's not a long-term loan like a home mortgage or something like that. Then there's finished goods inventory. This is stuff that you've manufactured. You got it waiting on your loading dock just for some customer to order it, and then you will ship it. And once you ship it, you present them with an account receivable. And then there's other inventory. This would generally, after finished goods inventory, you have in-process inventory and raw material inventory. Those things will take a little longer to convert to finished goods and then to accounts receivable and then to cash. So there's a number of steps that go along the way. And then there's a category, kind of a catch-all called total current assets. So I've got the data for 2 consecutive years, 2018 and 2019. These numbers are in thousands of dollars. So this really is $71,900,000, okay, in total current assets as of December 2019. Then you have other assets, okay, after current assets, and you have other investments. You have plant and equipment, and you put it on the books at what you paid for it, but then that's the installed price, of course, and then you start depreciating it. You subtract wear and tear that both time and use take on the asset. So then you get the net amount that's left that equipment is on the books at, so to speak. This may or may not be the actual value of the equipment, but it's the book value, okay? And then there's things like prepaid expenses and deferred charges, and I describe examples of those things down here in the footnotes. I'll let you read those. The next thing you have is liabilities, and remember, assets equal liabilities plus net worth. Net worth, another word for net worth is owner's equity. But we'll talk about liabilities and owner's equity next. And so under liabilities, generally speaking, they're listed in the same order of kind of liquidity when they come due, so to speak. We have current liabilities. Those are things that are going to be due within a year. Now, think about it. If you had less current assets than you had current liabilities, that's like having more bills than you have money in your checking account. You're not going to be able to make it unless you go out and borrow more money or something like that. So under liabilities, we have accounts payable. Well, when you buy stuff from your suppliers, they also send you an invoice, and that's an account payable to you. Notes payable, that may be loans that your company took out that are kind of short-term loans within 1 year. I put in current liabilities. If they're long-term loans, they would come down further in the liabilities listing. And then you have accrued taxes and other liabilities, and that number is, for example, when a company takes Social Security out of their employee's check, they don't immediately send that to the federal government. They stack it up in an account, and that becomes a tax payable then. Okay, that's an accrued tax. Then you'd add all those up and get total current liabilities. For 2019, you got 15, 10, and 3, which amounts to $28,000. Then you got other kind of liabilities, more longer term. Here's the first mortgage bonds. These are bonds that the company issued and they're going to come due at some point in time, and there's $20 million worth of those. And then the debenture is essentially a type of bond. It's a bond, and a bond is a loan. Okay, so these are loans. Okay, and so that you add those up to the total current liabilities, and you end up with $58 million worth of liabilities for this company. Well, we saw that they had $71.9 million worth of assets. So if you take the assets minus the liabilities, that's the net worth or owner's equity. That's what the owners own of these $71.9 million. And that we break down into different kinds of stock: preferred stock, common stock, capital surplus, and retained earnings. And you add all of those things together, and you get $102 million worth of owner's equity. I'm sorry, the total assets were $160 million. That was just the current assets. That's $71.9 million. The total assets was $160.4 million. And so you had $58 million in liabilities. You subtract that from this to get basically $102.4 million of owner's equity. So basically, of the $160 million worth of assets, $58 million of that was paid for with borrowed money. The other $102 million was paid for by the owners themselves. And so that's what we mean by the balance sheet. This number, the sum of these two numbers, the liabilities and the owner's equity, have to add up to the assets. So what we're going to do, though, is we're going to look at, this is the balance sheet, of course. We're going to also look at the profit and loss statement. As I said, this is as of a certain date, and what I've shown you is as of the end of two different years, the end of 2019 and the end of 2018. For example, during that year, the number of assets, or the value of the assets, went down from $169.3 million to $160.4 million. However, the owner's equity, the part that the owners owned, went up almost $10 million. Okay, so they had less liabilities, a lot less, from $76.5 million to $58 million. So the next statement we're going to look at is the income statement or profit and loss statement. And again, I've got a pretty simplified one right here in your handout that you can download from the website. And we've got net sales, and this is for the whole year ended December 31st, 2019. Net sales is $300 million. Again, these are all in thousands of dollars. And then gross profit, from that you subtract different kinds of operating expenses, selling cost, administrative. These are the cost of goods sold is predominantly the cost of your raw materials, your labor, your kind of your factory cost. But companies have a corporate headquarters, they have a sales organization, and so on. So this gross profit number then gets reduced by having to pay for these other things. So selling expense, general administrative, lease cost, a gross operating income. Then when you subtract that 49 from the 112, you get 63 million. And then you have depreciation on your equipment, so that is a tax deductible expense, and net operating income of 43 million. So this 20 is subtracted from the 63 to get the 40, and then you have other operating, less other expenses, notes payable, first mortgages, debentures. Those are the interest and dividends. You pay those, you subtract that from the 43, you get 37 as net income before income taxes. And then the federal income tax on corporations was recently lowered from about 35% to 21. So now I've got this number here, which is 21% of this, and I get net income after income taxes. And this number will go into your, well, two things. When you have this income that the company earned, they declare dividends, so you have to pay dividends. So I show that the previous balance in the retained earnings was 32.8 million. And let's see, that's right here in the balance. Well, let me bring this over. The balance sheet is here. That number here, retained earnings, was 32.8 at the end of 2018. So we added then to that what we made in 2019, 29.862. We got 62.662. And then we subtracted from that the dividends that we paid to stockholders. Stockholders are owners of the company. So they basically decided to pay themselves this 20.262 million, and that left them with 42.4 million in retained earnings, which is right here under 2019. Okay, so this is the income statement. It's how it relates to the balance sheet. There's a couple of items that relate back over. And then there's this third document here is the statement of retained earnings or owner's equity. And so those are the predominant two statements plus this one statement that kind of ties these together a little bit from year to year, so to speak. And what I'd like you to do for your project, well, first of all, you have to read the spec sheet. This is the specification page. So you're going to have to get these kind of documents on the company that you selected. And I'd like you to get actually more than 2 years. We just have a 2-year sequence here, 2018 and 2019. It'd be good if you could get several years. But the specification sheet that I have here and it's posted online tells you exactly what needs to be in your report and how it needs to be laid out and in sections and so on. So you need to read this very carefully, follow the directions. In other words, check out every square and you'll get credit for your project. Now, one of the things I like to do with a company is one of the ways we evaluate their financial condition is with different ratios. And there are 4 types of ratios. And you will have to be able to calculate at least one ratio in each of these 4 from the data you collect on your company. One is called a liquidity ratio. Remember what liquidity meant? Liquidity means the ability to convert an account to cash. So the more liquid a company is, the better off they are. Why? Because most companies that go bankrupt, it's not because they don't have assets. It's because they can't convert those assets to cash to pay their bills. And then they have to go bankrupt. That's happening a lot now in the pandemic, especially in some retail businesses like clothing stores and things like that. They have lots of clothes. They have, and other kinds of assets, maybe buildings and, parking lot space and stuff like that. All of that's great, and it helps you make money. But if nobody's buying your product, you run out of money to pay your bills. And so liquidity ratio is essentially a measure of how well a company can pay their bills. In leverage ratios is how much debt does the company have compared to how much the owners put into the assets, okay? Remember, liabilities are debts, okay? So if you're heavy on liabilities, you're heavy on debts, that may not be a good thing. Activity ratios are how efficient is the company running? Does it carry a lot of inventory that may not be able to be sold if times go bad, so to speak? And then there's profitability. When you sell product, do you make a good profit on it? Different kinds of businesses make grossly different profit margins. For example, a grocery store probably doesn't make a big profit margin on each item, but since they sell their inventory so frequently, they probably turn their inventory over 12, 13, 15 times a year. They don't have to make a big profit each time, okay? So we're going to look at these ratios then. And one of the things I'd like you to be able to do is actually plot how the company's ratio looks over time versus the industry average. And that's what I've done here. For example, the current ratio, which is actually, we'll see in the next slide or two, it's the current assets divided by current liability. So you always want to have more assets that are converted to cash than you have liabilities that are going to draw on your cash. So that ratio needs to be greater than 1. And our company, Manhan Corporation, is definitely greater than 1, but not too much greater, and it's going up. The industry average is much higher, and the conclusion I would draw from this is it's below the industry average, but that may not be bad. It may mean that they're deploying their assets more efficiently. But you definitely want it greater than 1. If it's less than 1, it means they may not have the cash to pay their bills, and that's what bankruptcy usually means. Now, certain companies are not going to go bankrupt because of that, but you have to be careful with them. Certainly, if it's a retail organization, I'd be worried. If it was probably a chemical company, I wouldn't be too worried, or something like that. And then return on net worth is a measure of how well they do at basically net worth. Remember, is the amount of the assets that are paid for by the company. So this is the return on net worth, and you see it's approaching 25% around there. It started at 20 and it went up and down, and it's well better than the industry average, and in fact it's going up when the industry average is going down. So this is basically a very good looking graph. This is not as good looking, but it may be okay. You'd have to dig deeper into that. It's definitely bigger than 1, and that's the most important thing. So you would have to count. I want you to find a minimum of 6 ratios total, and you have to have 1 in each category. But you might have, say, 2 in one of these categories, and actually, you'd have to have a minimum of 2 in 2 of the categories and 1 in 2 of the categories to meet the 6 overall ratios, and at least 1 in each category. So now we're going to look at some of the ratios for this data that I presented. For example, the current ratio is one of the 2 liquidity ratios that I have listed. And if we take a look at that for this company, Manhan Corporation, recall from our balance sheet, this is our balance sheet. The current assets for 2019 were 71,900,000. So that's this number right here in the numerator, and the current liabilities down here, total current liabilities 28 million. So this company has a current ratio of 2.75. Well, that's well bigger than 1. Okay, so that's pretty darn good. We're fine. And then we have a quick or acid test in which you take the numerator, the current assets, and subtract the inventory. Because what happens if you can't sell your inventory? And that's what's happening to a lot of companies that are going bankrupt in the pandemic. They have plenty of current assets, but a lot of it's in inventory and they can't sell it. So you divide that by current liabilities. Well, again, let's look at what we have here. We have total current assets of 71.9, but when we look at the categories that are inventory, which are these two categories here, okay, we add those, that's 29.4, okay, or is it, let's see. Yes, I guess it's 29.4, and we subtract that from the 71.9, and we end up with $42.5 million divided by the 28 million that is total current liabilities. The denominator is the same. It came from down here. Whoop, can't see that. From down here, that's the denominator, and so these two ratios come off of the balance sheet. I put a little star here to represent those things that come off of the profit and loss statement. Most of these ratios come off the balance sheet. The next type of ratio are leverage ratios, and I've gotten two here: total debt to total assets. Total debt is total liabilities and total assets. So if we look at the balance sheet again, our total liabilities are 71.9 million. Our total assets, where's the total assets? There they are, 160.4 million. So we have, well, let's see, did I get that wrong? Total liabilities. Oh no, the 71.9 is the total, I'm sorry, those are assets. Here's the liabilities. The total liability is 58 million, okay, and then the total assets are 160.4 million. So that's the 58, the 164. Okay, let's do that one again. Total liabilities over total assets. Here's the liabilities. There's the total liabilities. Here's the total assets. Actually, here and here. Okay. So the next ratio is called times interest earned, and here we get the gross operating income, and that's got a star on it because it comes from the profit and loss statement, and then we divide that by the interest charges, which also comes from the profit and loss statement. So gross operating income is right here. It's 63 million, and then interest charges. We've got interest on notes payable, interest on first mortgage, interest on debentures. So they add up to 5.2 million. So we divide that 63 by 5. We've got plenty of operating income to pay the interest on our loans. So we're in good shape there, okay? That certainly needs to be greater than 1, but the bigger the better, so to speak. And then the third category of ratios is called the activity ratios. And that gives you net sales divided by inventory is the first one, which is called inventory turnover. And for example, like I said, a grocery store might turn their inventory over 12 to 20 times a year, okay? This particular company turns it over 10 times a year, and that's really good, okay? And that's net sales, which comes off of your profit and loss statement here. Net sales is 300 million, and you're dividing that by your inventory level. And the inventory does not come off the profit and loss statement; it comes off your balance sheet. And so we look up the inventory under our assets, okay? You got finished goods inventory, other inventory. Those are the two main things. And so when we divide by the amount of inventory, we got 29.4. These two items here add up to 29.4 or 29,400,000 because these are all in thousands of dollars, which is typical of corporations' balance sheets. So that turns out to be 10.2. Fixed assets divided by turnover is net sales divided by fixed assets, and so on. I'm not going to go through the rest of these. I think you can find where I got the numbers from, and so what I want you to do is get one ratio on your project report, one ratio minimum from each of these 4 categories, and then at least 6 total ratios. So on at least 2 of the categories, you have to get 2 ratios, or maybe if you got this category, you could get 3 out of that category, or this one. So that's part of the project. Then the last thing is a kind of a funds flow. You start with the cash, and these are all things that we either find on the balance sheet. I think they're all on the I'm sorry, usually not the balance sheet, usually the profit and loss statement, and then you end up with return on investment over here. And this is just to show you how a company makes their money and how it can be viewed as a graphic. For example, cash and securities, that is actually on the balance sheet, right? If we look at the balance sheet, the first category is cash and the next one is marketable securities. So you add those two together, you get 10.5 million, and that's that number right there. Accounts and notes receivable, again, looking at the balance sheet, you got accounts receivable, you got notes receivable. Those two items add up to 23.7 million, and that's there. You add those two together plus your inventory. The other categories there are inventory, I guess, and you get total of 63.6 million. And then you look at the other assets and you add up all of those and you get 96.8, and that gives you the total assets, which we saw was 160.4. And then you're dividing your net sales by your total assets to get your turnover ratio. And and then you actually multiply your turnover ratio times your income as a percentage of sales to get your return on investment. But these items, then you see they're starred again if they come off of the profit and loss statement. Okay, this comes from the income statement or profit and loss statement if it's starred. And you see all these items are starred, and you're adding them all together to get this 280.344 million. You're subtracting that from the net sales to get net income, and then you divide that by net sales to get your income as a percentage of sales, and then you multiply that times the turnover ratio. I gave you some sources of data. Nowadays, the internet is probably your best source of financial statement data. Companies usually post it. It's usually pretty gross data that's posted, but you may be able to find the ratios you need from what is posted online. And so I'm going to go from here to talk a little bit about the excuse all this paper shuffling, but there's a lot of stuff here. Your project course requirements. So what you need to do is select a publicly held company. That means its stock is traded on a U.S. stock exchange, because if it's traded on a U.S. stock exchange, you'll be able to get financial data, because the U.S. government requires companies to put that data out there. Okay, so send me the name of the company if you haven't already done so, and I will approve it if no one else has already claimed that company, and then you can get started on your project. I want your report to have a title page and a table of contents, and I describe everything that has to be there, okay? And the grader is going to check and see, did you have this, did you have that, did you have the other thing? And if you have it, you're going to get the credit. Okay, and then there's going to be an introductory section, state the purpose of the project in a report, and why did you select the company you selected, and so on. And then you go on with each of these items, okay? And I've listed not only what you need to put there, but the points that will be gained on that. When you do the stock price, I want it in your own Excel spreadsheet, okay? I don't want you to clip a stock chart out of off the internet and just plug that into your report. I want you to plot an Excel the data from an Excel spreadsheet in your report, okay? And this describes that. And then I want you to do the financial analysis, where you have the balance sheet, the profit and loss statement, and you do those ratios, okay? And then draw some results and conclusions. And what do you recommend about this company? Would you invest in it? Why or why not? Would you be employed by the company? And then list any references. If you list data that you got off the internet, list the date that you got it, as well as the link. Okay, what website did you get that data from, and when did you get it? And so your report should be typed, double-spaced, at least 5 pages in length. That's excluding the title page and the table of contents and the references and the tables and figures. So I want you to have some narrative there in 5 pages of it, basically. So that concludes my discussion on your project and what's due and basically how to do it. Thank you.